Hello everyone, hope you all are doing well. So today we are going to discuss lecture number 22 of IFRS 9 Financial Instrument. I will divide this lecture into three parts. Today we will cover part 1 and tomorrow we will cover part 2 and day after tomorrow we will cover last lecture and the part 3. Let's start IFRS 9 Financial Instrument. This is one of the most important standard for ACCA, SPR, F7 and for other professional qualification students. Let's start first with the definition. What is financial instrument? Financial instrument is any contract that generates financial asset for one entity and financial liability or equity instrument for other entity. Let's say a company X wants to secure a fund. And in order to secure a fund, company X give their shares to the investors. So it means for the investors, shares are financial assets, and for the company, the loan amount is a financial liability because company has an obligation to repay the debt. So this is financial instrument for one party. This will be a financial asset, financial liability, or equity instrument. Let's read the difference between financial asset and financial liability. Financial asset, cash, contractual right to receive cash. Contractual right to receive a financial asset is also a financial asset. Exchange of financial assets that are potentially favorable for the entity. Equity instrument of other entity. Financial liability. There is no cash. Contractual obligation to deliver cash. In financial liability, we have an obligation to deliver cash. Okay, you have to be skeptical while explaining the difference between financial liability and financial asset. Contractual obligation to deliver financial asset is also a financial liability. Exchange of financial assets that are potentially unfavorable for the entity. That are potentially unfavorable for the entity. It means, let's say, Company A has obtained a loan from any institution, and there is a possibility that the interest rate may fluctuate. Company A asks that if the interest goes up, I will pay you $100 extra. Now, in the financial market, the interest rate goes up. Now, it is an obligation of the company A to pay $100. So, this is unfavorable for the company A. Now, there are following points which indicate that this is not a financial liability or a financial asset. Let's read one by one. Inventory, property, plant, and equipment prepayments are not financial asset. 99% not a financial liability. Warranty provisions are normally not a financial liability. Warranty by teacher to refund cash is a financial liability because teacher has an obligation to pay. The key word is an obligation for financial liability, and for financial asset is to receive. Redeemable preference shares are classified as financial liability because the person has the obligation to deliver. Let's say there is a mutual funds and we as an investor invest our amount into the mutual funds. Now mutual funds will invest our funds on behalf of the investors to the stock market, and whenever stock points goes up, we get some Return. So there is an obligation on the mutual funds to repay or to return our investment on return. Now, income tax liability are statutory obligation, not contractual obligation. That's why not a financial liability. Ordinary shares are not a financial liability. Cash dividend is not a financial liability because it's depend on the company to company. So no financial liability if no contractual obligation, tax payable or dividend payable. Let's read the equity. Residual interest in the entity's assets after deducting all liabilities means net assets minus total liability is the equity. Residual interest in the entity's assets after deducting all liabilities. Now, redemption premium. These are the kind of interest, or you can say type of interest. Redemption premium, it will be spread over the life of the loan by using effective interest rate. If you are obtaining a loan, then sometimes it is mentioned in the contract that I will pay you a redemption or a premium on the principal amount. Discount. In economic reality, discount is an interest, so it will also be spread over the life of loan. We will cover the questions on these terms. Issue cost. Issue cost is incurred to raise the loan, so it will also be spread over the life of loan. Physical interest. Physical interest is the interest paid each year by using coupon nominal rate. Physical interest or equal to face value of coupon rate. You have to remember that coupon rate always apply on the face value. Don't get confused between the fair value and the face value. Coupon rate always apply on the face value. Physical interest is the contractual obligation on the borrower to pay. Now, we used amortized cost accounting, amortization schedule, opening plus interest expense minus cash. This one, coupon rate, interest paid equal to closing balance. Now, effective interest rate. What is an effective interest rate? Effective interest rate or IRR. You have read IRR in your F9 exam. EIR, effective interest rate slash IRR, is the rate in which an investor, those who are providing the funds to the entity, in which an investor gets his return. It can change due to transaction cost. Now, what is transaction cost? Transaction cost is the cost which is paid by the investor at the time of investment. So, when we solve questions, you will get the idea that the EIR or IRR will always be greater than the coupon rate. In most of the time, EIR is always greater than the coupon rate. Now, what is a coupon rate? Coupon rate is the one on which borrower pays interest, means the entity who is obtaining the funds or loan. Market rate. Market rate is the one on which loan obtained from the market, means for the all over the borrowers. Coupon rate is fixed, but market rate can change due to change in money supply because it relates with the market. So market rate can fluctuate due to change in money supply. Now there are following questions for your conceptual clarity. Question number one. Let's say company X face issues. Company X obtained loan of 1,000 from ABC Bank. Effective interest rate is 10% and a redemption of 331 paid along with principal amount at the end of third year. In this case, no coupon rate means no during the year payment, only interest. So it means no coupon rate, so no physical interest, no contractual payment, only interest, effective interest. Now you have to make a amortization schedule. Year 1 to 3 as the terms are for 3 years. Opening balance is 1,000 multiply by interest rate which is 10% gives you the 100 interest expense, and the closing opening plus interest expense equal to 1100. In the second year, the closing will become opening of the second year. Again, you apply 10% on this figure, gives you the 110 and closing 1210. This year closing will become opening of third year 1210. Multiply by 10%, 121. 121 plus 1210 equal to 1331. Now you can identify that it's mentioned in the question that redemption of 331 along with principal amount of loan. So the principal amount of loan is 1000 and the redemption is 331. So 331 plus 1000 equal to 1331. So at the end, company X will pay 1331. What is redemption premium? Redemption premium is just like an interest, nothing new. Question number 2. Now economic condition of company X. Now economic condition of company X is stable. Company X issues bond with face value of 1000. Now company X is in a better or in a stable economic condition. That's why they issue bond with a face value of 1000 at the effective interest rate 10% and a premium of 165.5 paid along with principal amount means this amount. Now in this case, company X is also paying a principal interest. Principal interest is the contractual obligation on which company X pay 5%. So it means company X will pay cash during the year. So when company X will pay the cash, so their liability will reduce. If you make an entry in this question number 1, the entry is interest expense debit 100, loan payable credit by 100. But once we make entry in this case, you will see the loan payable will be amortized over the time. Why? Because the company X is pay the amount of 50, which is a cash. So this cash will reduce the liability by 50. 100 minus 50 is 50. Again, the same schedule 1, 2, 3, opening 1000, multiply by 100. Now, cash because company X is going to pay 5% on the face value. Face value is 1000. 5% multiplied by 1000 is 50. You will deduct this 50. The closing will be 1050. This closing will become the opening of the second year. Again, same method, and in the end you will see 1165 as mentioned, 1000 plus premium 165.5. So you can add both these, it will become the same of the end of third year. Now the entry of the first year is interest expense debit by 100, cash payment 50. Now you can see it reduces your liability, your loan payable amount by 50. So this is what in case of coupon, if there is a coupon or physical interest payment. Now you can ask why two different rates, effective interest rate and coupon rate. Let's read. Perspective basis rate applied, cash payment, legal contract, physical interest, coupon 5% is the legal contract on which the term is specified. But why effective interest? This is for the investor's return, so that investor can get the idea or investor can get the confidence. Yes, we will recover our investment. So this is for the investors. Now, cash payment, legal contract, face value multiply by coupon rate, accounting expense, economic substance, carrying amount multiply by effective interest rate. Effective interest rate will always apply on the carrying amount, or you can say net fair value, not face value, net fair value. We will identify or solve questions on net fair value or carrying amount as well. So you have to be skeptical about these differences. Okay, don't get confused. Now, real world view. Company pays fixed interest to bond holders based on the coupon. But if records interest expense in financial statement using the effective rate which reflects the real cost of borrowing. Summary. Term, coupon rate, effective interest rate. Set in contract, yes, not in contract. Used for cash payment, yes, no. used for accounting. In accounting, we record interest expense at effective interest rate. Reflects time, value, and market rate. No, yes. Now, there is an additional concept of discount. What if a company offers a discount on the loan note or on the bond? Let's solve this one. Company Y issues loan note at a discounted price. Face value of loan note is 5,000. Company offers discount of 2,000. So the cash received fair value is 3,000. Effective interest rate is 20%. Coupon rate is 10%. Now you can see when we apply 20%, we apply 20% on the 3,000. This is the carrying amount, net fair value. So 3,000 will become your opening interest expense. 20% multiplied by 3,000 is 600. Again, there is a coupon, means company Y is making payment at 10% of face value. 5,000 multiplied by 10% is 500, gives you the closing of 3100. This closing will become opening of the second year. Again, 620, 20% of this figure 3100 gives you the 620 minus 500, 3220. 3220 become the opening of the third year. Again, 644, 20 multiplied by 3220 gives you the 644 minus 500. The amount at the end is 3364. Now, effective interest rate always on carrying amount, net fair value. Coupon rate on face value. Year 1, interest expense debit 600, cash 500. This is actual interest paid. Okay, loan payable 100. How 100? Because you paid 500 out of 600, so still you have a liability of 100. Now, why we incurred cost to raise loan, and now this loan will give benefit to us for 5 years, means for next 5 years. So we should spread this cost over 5 years. Let's solve question on this. Question number 3, face value of loan 20,000, coupon rate 4%, discount rate 2.5%. There is an addition of discount rate, issue cost, redemption cost. Okay. Issue cost is 534, redemption cost equal to 10%, effective interest rate 7%, term 5 years. Oh my God, so many cost and discount rate, coupon rate. Okay guys, be relaxed. Now, face value is 20,000, from which we deduct discount 500, gives you the cash received 19,500. Okay, out of this 19,500, we also pay or incurred a cost, issue cost. We will have to deduct this cost 534. Issue cost is incurred by the entity who is obtaining a loan. Now, the net loan is 18966. Opening 18966, interest expense 7% on this opening gives you the 1328. Now cash, we know coupon rate always apply on the face value. Face value is 20,000 multiplied by 4 gives you the 800. So 18966 plus 1328 minus payment 800 gives you the 19494. This will become opening of the next year. Again, 7% on this figure gives you 1365 minus 800 gives you the closing of 20058. Again, this closing will become the opening of the third year. Third year closing will become opening of fourth year. Fourth year opening closing will become the opening of fifth year. Then you apply 7% on 21309 gives you the 1492. Again, 800. So the closing will be 22,000. If you can see, the question says face value of the loan 20,000. What is the face value of the loan? It's 20,000. And why the remaining 2,000 came from? We obtain a loan at a value of 20,000. If you can see, there is a redemption cost. 10,000 multiplied by 20 gives you the 2,000. So means we are also paying a redemption premium. So the total amount we will pay at the end of fifth year is 22,000. Okay, if you add all these 5 years interest, it becomes 7034. Now, if you remember in the start, we learned that all these costs, discount, issue cost, redemption cost, physical interest are kind of interest. Let's check this one. Spread over the life of project. First, we have discount. It's offered by entity, means company who is obtaining a loan. Issue cost also incurred by the company, so we add redemption premium also paid by the entity, so we are adding it. Coupon rate also paid by the entity, so again this one will also add. The total is 7034. Now you can compare both the figures as they both are same. So that's why these are all kind of interest. Now till these questions, the accounting we have done are from the borrower perspective. Now we are going to do the accounting with the perspective of investor, means the one who is providing a source of funds. Let's say question number one, 6% loan note purchased at face value 1 lakh, discount 5,000, transaction cost, we know transaction cost incurred by the investor 4,000. Redemption premium 11909, means in the end the amount we will recover from the borrower is 1 lakh plus 11909 gives you the 111,909. At the end, we will recover this amount. Effective interest rate 10% per annum. Maturity is 3 years, means term are 3 years. Face value is 1 lakh. Discount 5,000. Deducted cash received 95,000. There is a transaction cost which incurred by the investor, so we will add. Total amount is 99,000. This will be used for the effective interest rate on which we calculate the interest income. Now, financial asset 95,000 debit, cash credit 95,000 debit. Financial asset debit, cash credit, this is for the transaction cost. Now you are getting the concept of financial asset and financial liability. Previously we solved questions for the financial liability from the borrower perspective. Now we are solving the financial asset questions with respect to investor. Year opening interest income, this is interest income. Cash closing, okay, 99,000 is the opening on which you apply the effective interest rate, gives you the 9900. Cash you are received from the borrower is 6,000 at coupon rate. Coupon rate is 6%. Gives you the closing of 102900. This will become opening of the second year. Again, second year closing will become opening of third year. You will apply 10%, gives you the 10719, and cash which you receive from the borrower is 6,000. At the end, the amount you recover from the borrower is 111,909. Okay, again add these interest income. The total income at the end of third year is 30909. Okay, let's make these entries. Loan receivable debit, bank credit, the net amount. Loan receivable debit, bank credit. Bank debit, loan receivable debit, interest income credit. Interest income credit as you receive 99900 interest income. This is total income. And out of this total income, you received 6,000. So you debit bank or cash by 6,000. And the difference is 3900, means it is still receivable from the borrower. You should have to make the entries, this entries for the second year and for the third year. This is your assignment. Spread over the life of project. Discount paid by the entity, means the company who obtained loan from us. Coupon rate also paid by the entity. Redemption premium also paid by the entity, but transaction cost paid by the investor, so we deduct it. If you can see, the total is 309,909, match with the interest income. Now you got the idea how these costs spread over the life of project. Now question number 2, what if there is no effective interest rate or IRR in your exam? But this is very rare, but we all know there is a possibility that anything can come in your exam. So that's why I selected one questions. If there will be no IRR, how to solve this question? Face value 1 lakh, premium 6623 which borrower has to pay on principal amount, transaction cost 1000 paid by the investor, coupon rate 10%, term 4 years. Solution: to calculate fair value, face value 1 lakh, premium 6623, total fair value is 106623, add transaction cost gives you the total amount is 107623. Now you have to make the cash flows zero. In the zero you will write the total amount 107623 in the negative form. This is for the IRR. Okay, you have to follow these steps in Excel. Once you made this schedule, in the end you just have to press equal to IRR and range the cells, then the IRR will be automatically calculated. So 0, 1, 2, 3, and 4. Always start with the 0, and in the 0 you will have to write the total amount in the negative form. Then in the Year 1, you will write a cash flow at the coupon rate. Coupon rate is 10%. 10% multiplied by 10,000 is 10% multiplied by 1 lakh is 10,000. In the second year, 10,000. In the third year, 10,000. But in the fourth year, cash flow plus principal amount. So it will become 1,11,000. IRR is 7.7131%. Now amortization schedule. Year 1, 2, 3, 4. Opening is 107623, on which you apply effective interest rate of 7.7131, gives you the income of 8301. Now, cash which you will receive from the borrower at the coupon rate, which is 10%. 10% multiplied by 1 lakh is 10,000. The closing is 105924. This will become the opening of the second year. Again, second year closing will become opening of third year, and third year closing will become opening of fourth year. And in the fourth year, you also apply effective interest rate on 10123, gives you the figure of 7877, as you receive 10,000 interest throughout the years. So the closing is 1 lakh, which you can see equal to face value. But you can ask why there is no premium in the end, because this is if no IRR or effective interest rate is calculated, so we took the premium in the start, based on which we identify our IRR. If there is no IRR, then how will we identify the income, means for the shareholders or investors? The entry is cash debit, as you receive 10,000. Interest income is 8301. Now investment in bond is 1699. Question number 3 is your assignment. Just solve using these steps. Now, call option and put option. What is a call option and what is a put option? Call option means right to purchase, when you have a right to purchase. Put option means right to sale. Let's solve one example. Putable instrument, an instrument through which investor can claim money anytime from issuer of instrument, means there is a contractual obligation to deliver cash on issuer. That's why it is a financial liability for issuer. Investor has a put option, right to sale option. Example, let's say we invest in mutual funds of ABC Bank. ABC Bank invest in stock market on our behalf, means first we invest in mutual funds of ABC Bank, then ABC Bank invest our funds in the stock market on our behalf. Now we investors have some units which ABC issues to us. In this case, investors have a put option. Right to sale means redeemable. We learn this thing that it is a contractual or a financial liability. So ABC Bank has an obligation to deliver cash to investors. Now there is a summary for call versus put option. Feature: call option, put option. Definition: right not to, obligation to buy, right to sale. Holders intent: profit if price increases, profit if price decreases. Writer's rule: must sell if exercised, must buy if exercised. Strike price: buy means buy bought. Buy price agreed in contract, sale price agreed in contract. Premium paid by buyer to seller, which is non-refundable. And put option, it is paid by buyer to seller, non-refundable. So premium is same. Okay. Profit and loss summary for option holder who has an option. Scenario: call option buyer, put option buyer. If market is increasing for the call option buyer, profit; for the put option buyer, it's loss, only premium. If market is decreasing, call option buyer loss, only premium, and for the put option buyer it's profit. Why it's profit? Can anyone tell me? Because if market is going down, so we can sell, as we are in a put option. Put option means right to sell, but in the buy option we can't sell as we have a right to purchase. Example: let's say strike price equal to 50, premium paid 5. Call option buyer: if market price equal to 60, gain 60 minus 50 equal to 10. Why there is a gain? Because we have it on a strike price at 50 and the market price is 60. So we have a gain of 10. Profit 10 minus 5 as we paid premium. So the net profit is 5. If market price is 40, loss, only premium equal to 5. I hope you are getting the things with these examples. This is an additional concept just for your clarity or for your understanding. Put option buyer. Put option means right to sale. If market price equal to 40, sale at 50, buy at 40. Gain is 10, profit 10 minus 5 equal to 5. If market price 60, loss, only premium, which is 5. Accounting notes IFRS 9. Premium paid by buyer, which is asset. Premium received by seller, liability or income. Derivatives we will cover in the later section. Mnemonics: call equal to right to climb, buy at lower price, benefit when price rises. Put: right to push down, sale at higher price, benefit when price falls. Now, there is a contingent settlement provision, very important concept because most of the student may find difficulty in contingent settlement provision. Contingent, whenever there is a word contingent, it means there are conditions. Normally, equity contract plus contingency of cash payment. Normal equity contract plus contingency of cash payment means cash payment only in case of one or more uncertain future events which are not in control of anyone. Let's say the rain forecast, the death of someone, this and that, which are not in control of anyone. Example: Mr. A promised to deliver the shares to Mr. B, but he also said if stock market goes down, then he will pay cash to Mr. B. This is not in a control of anyone, as it can go up and can go down. So, treatment must be recorded as a financial liability, but there are two exceptions. If any one condition meet, then it will not be recorded as financial liability. In this case, it will be recorded as an equity. Exception: if attached conditions are highly abnormal. Cash payment only in case of liquidation, means if it is liquidated, then only cash payment. And if there are conditions which are highly abnormal, then in this case, even if both needs or anyone, then in this case it will be considered as an equity, otherwise financial liability. Compound financial instrument. Compound means debt plus equity. Convertible loan note. You have written so many times an entity issues a convertible loan note. Convertible loan note means the investor has an option either to receive its cash or the equity. Let's read the steps. Treat complete transaction as a loan and identify all possible cash flows. Okay. Discount all cash flows using market interest rate, effective interest rate. The difference between present value of future cash flows and consideration is equity option. Means total consideration less liability equal to equity. Unwind the liability element. Let's solve one question on this for your better clarity. Company A issues 6% convertible loan note of 1,000 10,000 redeemable after 3 years at a par, or convertible into ordinary shares. Market interest rate of loan without conversion terms equal to 10%. Air 1, 2, 3 cash flows at coupon rate 6%, 600, 600, and in the end, principal plus cash flow. So it's 10,600. Present value at 10% effective or market interest rate. The total of the present value is your liability, which is 9005.3. Present value of liability, total consideration is 10,000. The difference is 995, which is an equity. Now, amortization schedule. Unwind the liability element. Okay, remember these steps. Air 1, 2, 3, opening interest expense, cash closing. 9005, 901 as 10% of 9005 is 901. Cash 600, 6% multiplied by 10,000 face value. Remember, 9306 is your closing of first year. This closing will become the opening of the second year. Again, apply the same 10% and 6%. The second year closing will become the opening of third year, and again the third year opening will become the interest at 964. 10% of 9,636 is 964. Again, cash of 600. The total or the end is 10,000. So you will make this entry: bank debit, liability credit, and equity credit. Air 1, interest expense 901, cash 600, loan 301. Interest expense is 901, you paid 600, so still you have a liability of 301. And in the year 2, again the same entry, and in the year 3, the same entry. Now, in the end, the entity has an option. The first option is ask for shares. Entity can ask for its shares. So the investor has two options. Option number one, ask for shares. Equity 995, loan 10,000. Share capital at par value. In this question, there is no, so that's why it's empty. But you have to make this entry. And share premium will be the balancing figure. Now, what if the investor asks for shares? The entity will you make loan payable debit and cash credit because you are going to repay their amount. Equity debit, retained earning credit, 995 and 995. Now, two sources of finance. There are two major sources of finance: debt and equity. In case of debt finance, issue cost, interest, dividends, redemption premium, discount, all will be booked in P&L. In case of equity financing, issue cost, interest, dividends, redemption premium, discount, all will be booked in equity. We will solve this question on this topic, but in the tomorrow's class. If the cost is related to compound financial instrument, means convertible loan note, then split the cost between debt and equity element according to their weightage. If you have any queries or any questions till now, feel free to ask, because we will move to the next step in the tomorrow's class. Till then, take care and goodbye.